Okay, let's jump right into it. Ever since that historic shift away from LIBOR, the 3-month SOFR futures market has basically become the undisputed heavyweight champion of short-term interest rates. But if you've ever logged into your brokerage platform to trade them, you know what happens. You're instantly hit with this massive wall of contract dates stretching out almost a decade into the future. It's completely overwhelming. Trying to figure out where you, as an individual investor, should actually focus your attention is kind of like trying to find a needle in a giant haystack. So for this explainer, we're going to act as data detectives. We're going to uncover the mechanics of all these contract months, look at the daily trading volume, and build a clear, actionable strategy.
Because really, this is the ultimate question, right? Out of the 39 consecutive contract quarters available, stretching all the way into the 2030s, which specific month should a retail investor actually be trading? It's super intimidating. But to answer that without getting completely crushed by all the institutional noise out there, we have to follow the liquidity. We have to look exactly where the actual daily trading volume is happening.
5.4 million. Now, let me be clear, that is not a monthly total. That is the massive average daily volume of SOFR contracts traded in just the first quarter of 2026 alone. Over 5 million contracts changing hands every single day. This right here is exactly why SOFR Futures are the absolute go-to instrument for hedging US dollar short-term interest rates. The market is incredibly deep, it operates nearly 24 hours a day, and it's completely transparent. But here's the catch. That massive volume, it is not spread evenly across all those dozens of available dates. It's highly concentrated, and understanding exactly where that concentration is, well, that's your key to actually succeeding here.
The sheer scale of this market is honestly pretty staggering. Total open interest routinely sits right around 55 to 58 million contracts. And when you look at the breakdown, futures volume completely dominates the options volume. When you've got open interest that high, to put it into perspective, you are looking at equivalent notional values in the trillions of dollars. Trillions! But again, to find our optimal trading month as a retail investor, we really need to dissect this massive pie. So let's move into Section 1, Decoding the 3-month SOFR Calendar. The CME exchange gives us this huge window, 39 consecutive quarters and the 6 near serial months, providing a price indicator that reaches 10 whole years into the future. First off, let's just simplify a key mechanic. These are cash settled to a 100 minus R index, which just means if the SOFR interest rate is 5%, the contract price is at 95. Simple as that. Second, the dollar value of a 1 basis point move, the DV01, is exactly $25. So every single minimum tick really matters to your bottom line. And like we said, the exchange lists those 39 quarterly contracts plus 6 serial or non-quarterly months just so market participants can hedge risks with extreme precision a decade away.
Now here is the absolutely crucial part you need to understand. IMM dates. Because the 3-month SOFR contract's reference period is strictly tied to this quarterly cycle, March, June, September, and December. IMM stands for International Monetary Market. And for these SOFR contracts, the reference period runs from the 3rd Wednesday of the contract month, on the way to the 3rd Wednesday of the 3rd month after. Basically, these 4 quarterly months are the ultimate anchor points for the entire short-term interest rate market. The serial months, they just exist to fill the gaps, but as you'll see in a second, they do not attract the same kind of crowd at all.
Which brings us nicely to Section 2, Following the Money with the Open Interest Breakdown.
Let's look at the actual data from June 12, 2026. The open interest is heavily clustered in those near-term quarterly IMM months. Look at this. Out of millions of open contracts, the June 2026 contract alone holds nearly 1.9 million. That is over 13% of the entire market sitting in just 1 month. December, September, and March follow right behind it. These front-month IMM quarterlies clearly command the lion's share of participation. Compare that to a non-quarterly serial month, like April, which holds literally a mere 0.1% of the total. The daily volume tells the exact same story. The real action, for sure, is concentrated right here in the near term.
Now you might be wondering, well, what about those contracts expiring way out in 2028 or 2029? Those are primarily used by massive institutions trading consecutive strips for long-term hedging, what the industry calls packs and bundles. If you look way down the forward curve, you'll still see open interest, absolutely, but the daily intraday volume and the way it actually trades changes completely. Large banks use these packs to transact a strip of 4 consecutive quarters, so covering a whole year of risk in one single order. Bundles cover multiples of 4 quarters. It's just a completely different ballgame from day-to-day retail speculation.
So we have a really stark contrast here. While those big institutions need deep forward curve hedging, we as retail and day traders demand immediate liquidity and the absolute tightest possible bid-ask spreads. If you're an individual trader trying to jump in and out of the market quickly based on, say, a sudden Federal Reserve announcement or a hot inflation report, you literally cannot afford to be trapped in an illiquid month. If you try to trade a far-dated 2028 contract or some random serial month like May, the bid-ask spread is going to be wider, the order book is thinner, and the slippage on your entry and exit could eat up your $25 per tick profits instantly. No way.
All right, heading into Section 3, the optimal retail strategy. This is where we put it all together.
This is the big takeaway for this explainer today. For the individual investor, the data clearly 100% dictates that you should exclusively target the front-month IMM quarterlies, March, June, September, or December. Whichever one is closest to expiration but hasn't expired yet, that is where the daily volume is massive. Sticking to the front month gives you those razor-thin bid-ask spreads you need for precision entries and exits, whether you're hedging a small portfolio or just trading the short end of the yield curve. Let the mega banks handle the multi-year bundles, Your arena is the front-month IMM.
So now that you know exactly where the smart money trades, the only question left is how you're going to use these front-month contracts in your own portfolio. By hyper-focusing your attention on the front-month quarterly contracts, you strip away all that noise of the forward curve and tap directly into the most liquid interest rate instrument in the world. So check the calendar for that next upcoming IMM date and ask yourself, when the Federal Reserve drops its next surprise move, are you going to be stuck paying the price in an illiquid spread, or are you going to be trading right where the smart money flows?